What's going on, guys? Today is going to be day 4 of the trading bootcamp. I haven't posted in a little bit. I apologize. I have been pretty busy the last week. So yeah, let's get into it. So we've been over candlesticks, we've been over time frames, we've been over trends, we've been over break of structure. So we have been over some of the most basic ways of how the market moves. Now I want to go into another concept that is probably the most important that you are going to learn. And it's not even that hard. A lot of people make it a lot harder than it has to be. And I honestly don't know why, because it's not that complicated. I want you to think of like Star Wars, and I want you to think of the Force in Star Wars. You know, it's kind of like that. The market is a machine that is constantly targeting liquidity. And liquidity is not a hard concept because all liquidity is, put very simply, is money. Now, where is money found in the markets? It's found through orders, resting orders, which is the technical definition for liquidity. It's just resting orders in the market. Now, a lot of big banks, institutions, whatever, what they do in order to fill their orders is they will target liquidity. They will take people out of the market. They'll use it to fill their orders. And then in order for them to get out of the market, they have to target more liquidity to fill their orders to get them out. That was a lot. We're going to take it slow. We're going to go through it. Don't worry. So, where does we know that the market targets liquidity, but where does liquidity lie? How do we know where to find it? It's actually pretty simple. So all liquidity, or I should say, where liquidity lies is simply highs and lows. Seems simple enough, right? Now, while liquidity lies at highs and lows, there are certain draws on liquidity that are stronger than others. The reason why liquidity lies at highs or lows is because right here, if I were to enter, let's say I was going to enter a short, obviously the only way you put money into the market is by placing an order and for your order to get filled, right? So if I were to place an order in the market, people will place their stop losses above highs, previous highs, and below previous lows. So right here, if we look, right here is a previous high, right here is a previous low. There's liquidity that lies at both. People who want to sell are placing their stop orders above here. For the most part, people who want to go long are going to put their stop losses down here. Now, neither side can make money unless we go to one of the directions and target one of the draws on liquidity and sweep that liquidity, which is going to be another concept which I use on a daily basis all the time and is another one of the most important concepts. And all it is understanding, like I said, when big banks, I don't even know where this is going to go, but I'm just going to let it play for a second and just go off of it. So right there, everybody who wanted to go short, who were putting their stop losses there, betting that we were going to go all the way down here and take out all this and make a whole bunch of money, all of them just got stopped out, meaning they lost their money. But what does that allow to happen? It allows big banks and institutions, people who move the market, to fill their orders. So we had a liquidity sweep, which is just simply us hitting one of those old highs or old lows, sweeping out all of those stop losses and stopping all those people out, and then reversing from it. Now, I don't know if we're going to reverse from here, but there's a pretty solid chance we could. And what happens? I genuinely, like, completely blatantly, honestly, I did not look at what was going to happen before I did this. I found a random spot on the chart. And beautifully, what we see is that when we place our stop losses here, we had our liquidity get swept, meaning everybody who wanted us to go short got taken out of the market. But what that allowed to happen was for people, the big banks and institutions, to fill their own orders to push price lower. So like, okay, everybody who wanted to go short, who's like there, they all got stopped. Their money got taken. It got used to fill the institution's orders, which then got used to push price lower towards the next draw on liquidity. So I don't know what else is going to happen here. Looks like we did it again to an extent. We had a liquidity sweep here. We took the liquidity that was lying at this low. So like I said, anybody who wanted to go long, they got stopped out after that. And yeah, I'm going to go through a lot more examples, but I just want to kind of get across that this is one of the most important concepts to understand, because you can't make money in trading without knowing where price is going to go. And if you can understand where price is going to go, then you can use the framework for a strategy. Now, in my strategy, I guarantee you I can find some inversion, and we do right here. So in my strategy, this is a random moment in time, so I'm taking a lot of other factors and I'm taking it out for right now just to kind of utilize for this teachable moment. But in this moment, I would wait for this fair value gap, which you guys don't know what it is yet, or maybe you do, and maybe you're a little advanced. But for the beginners out there, people who are just watching this and don't understand how to trade at all, this is what I would call an inversion, and my entry model is based on this. So I would wait for liquidity to get swept. I'd wait for all of those, retail traders to get stopped out of their plays, and then I would go with the smart money, or the big banks and institutions, the people who really move the markets. I would go with the smart money after everybody gets stopped out, and follow the money all the way down to the next draw on liquidity, which would be here. Now in real time, what I would probably end up doing is, I don't know, probably break even at this swing low here, take profit down here. We can get into the strategy another time, but what really matters is the fact of understanding why price is moving where it's moving. Like I said, people overcomplicate it a lot, but we're going to go through the different types of liquidity. So there is two major types of liquidity, and then there's subcategories of each of these. I'm just going to give the main ones. I'm not going to give every single draw possible, because there's a bunch of different possible draws. I'm just going to give the main primary ones that I use on a regular basis. So first off, there is buy side liquidity. Buy side liquidity lies at highs only. Sell side liquidity lies at lows only. Now these highs and these lows can be more important or less important depending on the draw, and also depending on the time frame. Now here's what I mean by that. If I go to this hourly time frame, right? Overnight, this box right here is indicating the session of London, so London session overnight. So this London session low, which is a very key draw, is going to hold a lot more power in drawing price, which is actually what we were targeting, funny enough, than if I were to go to the 1 minute and I were to look at this random high right here or right here and say, hey, does this random high right here hold more power on the 1 minute? Because, I mean, but frankly, honestly, like 95%, not 95%, but most of these like 1 minute highs and lows, it's not, it is, they still have liquidity lying at these highs and lows, don't get me wrong. But what I should say is they don't matter nearly as much as like a London session high, a London session low, a previous day high, a previous day low, a pre-market high, a pre-market low, a data wick, etc. So I'm going to go into these and I'm going to write out a whole bunch of these draws on liquidity, and then we're going to go over them individually. We have buy side liquidity, which is one of the main category. All of these fall under either buy side liquidity or sell side liquidity. So sell side liquidity is just lows, and buy side liquidity is just highs, right? So for buy side liquidity, we have previous day highs, which are, put very simply, if you just go to the daily time frame, you go to the previous daily candle, because that represents the previous day's price action. You find the high of the wick, and then you place a ray right there, and you name it, previous day high, whatever. I just have mine because I place them both because I know the colors. It works for me. Whatever works for you. But as long as you know that there's a previous day high there, that is a drawn liquidity. Previous day low, same deal here. Previous day low at the bottom of said wick. I'm gonna move that down there. So at the high and the low, so the top wick and the bottom wick of the daily candle, those are both either at the high, the previous day high, and the low, the previous day low. Those are draws on liquidity that are significant and you should be looking for while you are trading. The next one I'm going to go over, let's just go through the list as we go. Okay, so London highs and Asia highs. These are overnight sessions that happen every night. They're wow, I can't even talk. Mapped out on here. So I don't know if they have this specifically perfectly. Okay, it looks like they do. I think that's from 2, right? No, okay, it's from 3. So the ICT kill zones are technically 8 to 12, and then for London 2 to 5, and that's what I've used forever. I guess some people use them slightly differently. I don't know. It's what's always worked for me. So I'm going to go off that for this. Sorry, I'm making it sound like that's not what it is. The Asia highs and lows. The Asia session, first off, is just from 8 p.m. to 12 p.m. Those are the candles you should be looking for. And then the London session is going to be from the 2 a.m. candle to the 5 a.m. candle. So when you're looking here, you're going to go from put simply, the hourly time frame, you're going to go to the 8 p.m. candle, you're going to go to the 12 a.m. candle, you're going to find the high or the low. Now, if the high has already been gone through, so like right here, the highs have been gone through, you're just going to focus on what hasn't been. So the lows, sometimes both of them are, and then there's no Asia highs or lows for draws. In this case, we had a Asia low or a London low, which we came down and we swept in, the whole one I showed you in the beginning. So these are both draws on liquidity. Now in this, I'm actually, yeah, so we drive through the Asia low and the previous day low. So today we swept out a lot of the buy side draws. So we had no Asia high, we had no London high. We did have a previous day high, but yeah, we ended up just wanting the sell side draws on this day. We're probably reacting out of a 4-hour, yeah, we were 4-hour gap, whatever. Get into that later. So that's going to be your Asia and London highs. We're going to go through pre-market high. This is typically, I'll use this when an Asia session or a London session, there's typically not a low for either of them, or they've both been mitigated. I'll just mark it. It is still a draw on liquidity. It is probably, I'd say, less significant because it's typically, sorry, I'm just trying to make sure this is up here. It's typically after we have already taken out either draw. So it's still technically a relatively more significant high or low than like just a random high or low, but it's definitely less significant. So that's just marked out by all of overnight. So 6 p.m. to, I guess you could say 5 is what I would use because that's the end of London. So 6 p.m. to 5. So right here, this would have been previous day low right here. I don't know if I have it on back testing. We're just going to use this line without marked as London for the previous session low. So this is going to be pre-market low. This is going to be pre-market high up here. And that's what we're going to use. Those are both draws in liquidity. Data wicks and data lows, those are going to be when a significant news event hits on the 1 minute time frame, not the 2, not the 3. Go to the 1 minute time frame of that news event. If we have 8:30 news and we leave a data wick high, if 8:31 takes that wick, it is not a data high that's valid. Same thing for the lows. If we leave an 8:30 wick that's a low, mark that wick, because if we go and we leave an 8:30 wick below and then we go way up here, it is a draw that will draw down. We had a very clean example of it today for NFP. We left the data low, we had a data high, we ran the data high out, we ran up a little bit higher, and then we trashed through the NFP data wick low. So for the last draw, we have equal highs and equal lows. This is a very significant draw. I will never trade against an equal high or an equal low. It's one of my rules. We had a good example of it when we were first going through the beginning of the video with the lows down here. Now, we had equal lows, relative equal lows. Where was it? I'm trying to find it. The 5 minutes more clean. We had relative equal lows right here. This is also known as LRLR because we have pretty, like, I would consider this an equal low as well. We have these two equal lows. Now the reason equal lows and equal highs are more relevant than just normal highs or normal lows is because people will put a stop here, then we're going to come all the way down here. People who are wanting to long will put their stop below here, so it's like double the liquidity of a normal high or a normal low. I think the last one, is that the last one? Yeah, looks like it is. So the main kind of points of this is that the market targets liquidity. The market will constantly go after these highs and these lows. It does it every day, pretty much on a consistent cycle, not of the same highs or the same lows in a row, but these London highs, London lows, and Asia lows, and previous day highs and previous day lows, I'd say are your main 3. Now, equal highs and equal lows are also just as important, but they typically will happen in the formation of these, and you can typically build your narrative around them throughout the day. Now, when you go watch a whole bunch of days back, it'll be a lot easier to spot these, and you'll get a lot better at it over time. But the main concepts that I want you to think of is kind of like an underlying force of the market, and think about it throughout the rest of the boot camp of the fact that that's what the market is going after. It's either using, it's either trending towards that draw and it retraces and then keeps going towards that draw, or it will, like right here, perfect example, came down, lower low, lower high, lower low, lower high, lower low, lower high, lower low, and we kept going until, we hit Asia low down here, then we kept going, and then we hit previous day low, and so on and so forth, and then the market will break structure back to the upside, and it will keep going the opposite way to target that liquidity. So really, really understand that liquidity is what we build everything else off of. We're always targeting where is the draw on liquidity. is the number one thing you should be understanding as to where the market's going, and really try to make sure you're understanding it. So highs, lows, and make sure you look at that list that I wrote out for you and go through and identify, go back test. I use FX Replay. It's not like a sponsorship or anything, but I would definitely check it out. I do use the paid version. You can do like a free trial if you want to, or do I think it's like a small paid version, but I think the $35 is worth it. I use it all the time if I have any questions for anything. But yes, that's Liquidity.